Welcome to an introduction to accounting brought to you by Parkbench Tutors. In this podcast we are going to examine a situation where a business is currently operating purely on cash sales and they want to consider whether to go and accept some sales on credit. So they've set out their cash flow statement on a cash basis at the moment, assuming that they take all their sales revenue in terms of cash, and this has got a number of variables in it. They are assuming that the sales increase per month is going to be of the order of 3%. They estimate their sales at the start. They know their bank balance at the start. They're also estimating that office expenses, their major expense, will increase by a certain percentage per month, and those are the suggestions for office expenses for the start of the year in January. Rent and wages are fixed, so we've put those in. If we just go to where we've got wages, there we can see that what in fact it refers to, if I go right up to the top, is that refers to wages. So if I were to alter the wages amount, let's say I made it 2,500 just out of convenience, then I would alter the projections all the way through. Anyway, using cash, what they're suggesting is that in January the balance at the end of the month will be 10,500 and it will slowly increase to 29,447. Right, now let's go down and look at what happens if they look to taking in a certain number of customers on a credit basis. And what I've done to begin with is assume that 50% of the customers are going to be given 30 days credit and the others will still remain on cash. If we just click on the 50 there for the percentage of customers, you'll note that I've also labeled the cell. Right, just to make it easy, that means I can alter that variable for wherever I use it on the second part of the spreadsheet. And if you have a look at this one, then you can see I've taken 100 minus the previous cell that I looked at up here. So if I alter one of these, then the other one will automatically alter. Now I filled it in for the first month, and the sales revenue in cash, right, will be F49, let's just look where that is. We've taken that from the first one, times 50%. So if I take that and highlight that cell and then go along to the top there we are, I can put all those figures in for cash sales for each month. That's fine, but how do I do it now for the sales revenue on credit? Well, obviously in the first month, if they've got 30 days to pay, which is about a month to pay, then they're not going to collect any money on credit. So what happens in the second month? Well, what they're going to have in the second month is essentially they are going to have 50% of the previous month's sales. That's what they hope to collect. So we will say the sales in the previous month were, here we are, we go back to this figure, sales revenue, and we multiply by our percentage of credit customers, which will be a percentage figure, and of course that should be 5,000. And now if we pull that across, you can see that what it's taking now is 50% of the sales revenue here. You may also have noticed that of course it's the 50% will be equal to that figure as well. In other words, 50% of cash is collected as 5,150 in February, therefore the other 50% is credit, will be 5,150 collected in March. So we can just pull that along. Now I have my total sales revenue for each month of the year, which I've now managed to enter. And right, now we can just about complete it, but it looks as if we've just got something to check here. F62 plus F66. 66 is here, right. Okay, I can see what I've done now. What I need, of course, is the total of the inflows, which in this case will be equal to the total sales revenue, and it's going to be the same all the way through. So I can just put that down there, so that equals 5,000, and I can drag that all the way along. Right, now I've got my total sales revenue. Good. And so far, so good. So we have an opening balance of 10,000 at the start, and a closing balance of 5,500, because of course what's happening is that we are collecting the credit revenue during the following month. So the bank balance is down, right? But note that the bank balance the following month is coming back up, and we drag this all the way along, and we can see that although the business isn't obviously going to go into the red anywhere, what is going to happen is that at the end of the year the closing balance will be less. In other words, there will be less cash available or cash on hand. This does not mean to say that the overall financial position of the business is going to be any worse off, because of course money will be still owed. In other words, there will be accounts receivable, but it does show what's happening to cash flow. And we can also show what happens if, for example, the sales percentage increase was 4%. We can go here, and if we alter that, you can see it's going to alter on both spreadsheets, and that's another advantage of using variables. And here's another one. This cell is labeled, so if we alter this to 60, you will see that that automatically alters to 40, and you can see that what happens is it has its effect on this as well. So supposing that the business went to 70% of credit customers, right, then you can see that the cash balance at the end of January would be even lower, and so on, right? If you went to completely credit paying, then of course you could have some potential difficulties in the first few months, because what happens of course is that you start with a very low closing balance at the end of the very first month. So you could advise this business that it will be unwise to go to a complete credit system right at the start, that probably a balance, which we suggested, of say 50% credit and 50% cash was more advisable. But the idea here is to use both spreadsheets and using variables again to show how by altering these we can consider what is happening if we start with a cash where everything is collected as cash, and then where a business is going to consider what happens if so many of its sales are going to be made on credit instead. Okay, thank you.